All right. Well, good morning, everyone. My name is Frank Fantozzi, President of Plant Financial Services, along with our senior advisors, Cynthia Yang and Amy Valentine, and we're here to talk about managing market volatility and uncertainty given the current market conditions. And the goal today is for us to comment on what we see happening currently in the markets today and probably out 6 months from now. Give you some insights as to how I think we think the economy, what direction it's heading. Are we heading for a recession? What the Fed's planning on doing, and really how it impacts the investor world. So with that, we're going to go to the agenda, and these are the key themes we're going to focus on today. And these are probably where we're getting most of the questions when we're meeting with clients or we're out, talking with others. Everyone's still focused on inflation. It's on the news every day. Same thing with the Fed tightening, the interest rates and increasing them, and see what's happening. What direction are we heading? Are we going to have a recession in 2023? Is it going to be a deep recession? If there is a recession, or it's going to be shallow, where you kind of just skipping rocks. We're going to hit the water and kind of start bouncing back. Focus on some of the principles of long-term investing. For many, people are long, and when they mean long, you're holding positions long term. So how you approach investing in that situation, given what we're seeing in the markets, is vastly different than what you see a day trader doing. So we want to make sure that people are investing for their long-term success. What are things that they need to think about? What are some of the positive trends we're seeing? Some tailwinds that are could be happening, and then portfolio implications and positioning. What does it mean for the investor, whether you're working with an advisor or you're doing it on your own? So I'm going to kick it off, and we're going to start talking about inflation, because that's been central stage for a while. A key component or key issue in why the Fed is so focused in on this is they really have a dual mandate. Their goal is to see have what they call low inflation and high employment, or low unemployment, depending on how you like to phrase it. And it's a really important to understand the concept behind that. What they're looking for with inflation is the ability to see that people can make purchases and have value out in the marketplace when they're dealing with goods and services. And employment is important. Obviously, it's like the health of the economy. When there's full employment, it's telling the Fed and the government that the economy is strong. So most countries, what I call developed countries, usually have a single mandate, and in the United States, we focus on a dual mandate. So it's really important. The Fed really drills in on this and focuses very hard. So on inflation, the thing that they're looking for is, what is the duration of inflation and what is the direction of inflation? And that's really kind of indicative of what the Fed is planning on doing with interest rates. When you hear the term hawkish, they're talking about raising interest rates because they're trying to figure out how to slow down inflation so that costs remain in check. So that's going to be an important indicator, and we're going to talk about this here. At this point, do we think inflation rates will continue, or are they going to continue to cool by the end of the year? And so what we have here on the graph up on the screen is what we call supply chain driven inflation. And I'm going to talk about that because there's two inflations that really happened because of COVID. The first inflation that happened was really the government's reaction to COVID. When the COVID outbreak happened in 2020, the government made a decision, and again, not to second guess the decision, that they were worried about having a financial collapse because everything was being forced to shut down. So the government dumped $2.8 trillion into the economy to make sure that the economy can kind of operate with money. Well, they talked back then, and they were very clear that inflation was going to happen. Okay, when you have that much money in the system, you have a lot of money chasing limited supply of goods. So you're going to have natural inflation because of that, because of the way the monetary policy occurred. And so that was what was expected and obviously occurred. I think what happened and caught more people by surprise, especially the length of this type of inflation, was supply chain driven inflation. So with everything being shut down, we saw videos of ships not being entering harbors, and goods being stuck out at sea, and difficulty getting any kind of goods, supplies of anything. All of a sudden, you had supply chain inflation occurring because there were businesses still operating, construction still going on. And if you needed goods, you were going to pay whatever price you needed to complete the job. So one of the things we wanted to focus in on today is what's going on with supply chain driven inflation. And what we're seeing here is it is starting to subside finally. And so we have three graphs that wanted to talk about today. The first one on your left, you see a gold and blue line. And what it focuses on is freight costs between the US and Asia and the wait times for those goods to get to the United States. And both, as you can see by the direction of the graph, when you look at ocean freight container costs, have dramatically dropped from from September of 21 to September of 22. So that's an important indication of the supply chain system in regards to the cost of goods is decreasing. The other is the days at anchor for ships. And again, that has also dropped a great deal from September, October of last year to September and October of this year. So that's a good indication of where, that we're heading out of the supply chain driven situation where goods are becoming more available, costs are starting to go down, and that's going to impact everything from manufacturing to direct goods that are being purchased by consumers. Another important thing to look at is really commodities. So commodities are, gas, for example, and oil, and food supplies. These are also coming down. So when you look at the Bloomberg Commodity Index, and you go from basically the high of March and May of this year to where we are in September, commodities are starting to show signs of improving. So these are two good indications of where, when you look at supply, and again, and its impact and cost on the consumer index is important to note that that's all going to be positive. And so when you look at the last chart on the right, and it looks at the CPI, and this is a chart that looks at year over year change. And it, unfortunately, the most current slide we can get is through August of 22. Right now, if you actually look at publications, we've dropped from the high of June of 22 of 9.1. We're approximately at 7.0 currently today. So the direction of inflation is also improving. So this is why the Fed right now is currently talking about potentially slowing down the rate of change as well as the amount of change. And what's been very, very disruptive is that if you look historically at inflation, inflation and how the Fed has responded with rate increases, what really threw the markets off this year is that bonds, which tend to be a very big cushion for investors, and most investors have some form of fixed income, the rate of change that the Fed incurred. So in other words, how many times they've increased in a short period of time and the amount of those increases were the largest in history, that really turned the whole bond market upside down. And so when you look at the worst point, which is about September of this year, the Barclays Aggregate Index, which is kind of like the S&P index for bonds, was down almost 14%. So that showed you the impact of the Fed and how serious they were with trying to rein in inflation. So if we go to the next slide, please. So the other thing we want to focus in on is when you hear the CPI index, everyone just calls it the CPI, but the CPI is made up of layers of data points. One of them, what we're going to talk about is shelter costs, but there's also commodity goods. There's various layers that make up the CPI, and it fluctuates. Those components change their positioning and their weighting within the CPI. And one of the factors that one of the bigger factors in the CPI is shelter cost. So the Case-Shiller index, what that looks at is single home costs and what's happening with single home costs. And they also look at rents, and they try to create an equivalent with rent to what rent costs would be in regards to its relationship to buying a single home. The reason why we focus in on this is the Fed is very data driven, and it really looks at the CPI. And what you're going to see here, we highlighted is what is called the 16th month lag. If you actually follow the blue line, all right, you'll see here to the far right that it's really starting to drop. And that's indicating that in real life terms, in real data, real time, is that you're going to see that cost of home ownership is starting to drop, the acquisition of a single home. Same thing with rents. So that's real time. Unfortunately, when you look at how the CPI is calculated, you'll see that the gold line is still on an upward trajectory, okay? And when you look at that upward trajectory, the Fed is focused on the CPI. And so there's a data lag of about 16 months. And that's why there seems to be sometimes a disconnect with what the Fed is looking at and what's really being seen in the marketplace. And so what that means to us as consumers and us as investors is that the Fed is still really focused on looking at trying to rein in inflation, because they feel that inflation is still not slowing down fast enough. And so what is the Fed planning on doing in December and the first quarter of next year? And when we look at, let me get ahead of myself. If we want to go ahead to the next slide. So what you're going to see here are a couple data points. The ones in red are and actually through November now, these have all occurred. So we started out with a 25 basis point increase. Then we went to 50. Then the Fed was very aggressive, and in a short amount of time had these 4 rate increases of 75 basis points. And now that inflation seems to hit its peak, the Fed is talking about lowering the rate of the next change, which is predicted to be in December about 50 basis points. And then what we're projecting out for first quarter next year is 25 basis points. Now, the reason why that's good news is that it's starting to signal that the Fed is still hawkish and feeling that we still need to increase interest rates a little bit more, but the rate of change and the amount of change is starting to slow. The only thing that could really throw that off is the economic data that we're going to be starting to receive this week and next week. So there's going to be employment data coming out this week. One of the data points that came out today was the consumer confidence index, and what that focuses in on is how does the public feel about the economy in general and what's going on. Anything above 100 is there's a propensity to say that they're very optimistic. Their ability to save and spend is going to be very good. When it stays below 50 and below 100 and starts to trend downward, that the outlook that they have is that they're looking to pull back on spending and saving. So the low point of this year was June of this year was at 50. As of last month, it rose to almost 60 and was at 59.5, I believe. Today it's at 56.4. So it's already started to drop back down. In actuality, while that's not a generally good outlook sign of what might happen in the next 3 to 4 months, the Fed is probably going to look at that as saying the interest rates and the increases are having an effect to dampen the economy. And that's what the government is looking to do, or the Fed is looking to do, is they want to dampen the labor market. In other words, soften the labor market, because if there are less people employed, there's going to be less spending. And that's going to be an important part. And if inflation is starting to come down slowly, that's also going to influence the Fed and how hawkish they're going to be in increasing rates and for how long. And what this is showing us is what direction we're heading and where we think we're going to end up. And right now we're looking, barring any surprises, we're looking at what they call a terminal rate of 5.0 in the first quarter. So that's where we think the Fed's fund rate will tip out at in the first quarter. So if we can go to the next slide, please. So what this graph is looking at is really what direction the Fed funds rate is going to attack, and what direction it's going to end up in. So, put things in perspective for some of us that are a little older. Back in the 80s, this number would probably be about 4 times higher. It's interesting because the Fed's fund rate has been tracked for about 60 years. Everything's relative. Right now, everyone's feeling that the cost of borrowing is very, very high. And when you really put it in a historical perspective, it's still in the I would say the bottom third of where historical rates have been. I think what has happened is we all get spoiled to some degree, that we've had like ultra low interest rates at 2.5%, 3%, and you get very comfortable that it's almost like having, you heard the term free money. Why not use the bank's money to go do projects? Because at 2-3%, it's almost like giving money away to be used. Well, that's changing, and I think we're coming into what we call historical normal rates, of where if you average out historically where we've been, where interest rates, the Fed fund rate will be at. And you can see it starting to climb. You saw at the bottom here, 2010, 12, 14, 16. We did have a little bit of a spike at 18 through 20, and then we had low rates 20 through 22. And now we've had this, if you look at how steep that climb is to 3.13% to 4.40 to 4.43, you're seeing how aggressive the Fed has been at trying to increase rates. What's important to look at is what is the Fed planning on doing, and where we think they're going to be, and what the market expects. And right now, I think the reason why you're seeing the market start to react a little more positively this month is that we've gotten through the election, and we'll talk a little bit about that later on. But the expectation of what the market is building in and what they think the Fed's going to do are pretty much aligned. And when you see that, the market then starts to settle in and feel like it has confidence at the direction of where the Fed's going. And it's pricing this into the market today. So the only thing that really throws this off is if there's a surprise. And what can be those surprises? Well, if unemployment still stays ridiculously low, if inflation, the drop in inflation, this week isn't significant enough, or it actually starts to go back up for some reason, that would greatly influence this and what the Fed might do. And if the Fed does something different than what the market is expecting, then you could see, a lot more market volatility. But we do feel that right now inflation is heading in the right direction, and that the Fed is noticing it. I think the Fed's more concerned that it's not dropping as much as it should be. So again, it's looking at, the direction and the drop. So they're trying to say, all right, are we heading in the right direction? I think we can all agree right now it looks good, but I don't think it's dropping fast enough. And that's why we feel that the Fed will continue with the 50 basis point increase, which has been planned. Again, it's not a surprise, and it's built into the market, and most likely planned for a 25 basis point increase, or 0.25% increase in the first quarter. So what impact does this have? If we, and I don't want to steal Cynthia and Amy's thunder, but when we start to see how the economy works out long term, if the economy settles in and basically self-corrects, you could start to see maybe interest rates coming down after 2024. I would not expect, and the team feels the same way, we wouldn't really expect much rate drop in 2023. I think if inflation comes down to an acceptable level and the labor market softens to an acceptable level, I think you're going to see these interest rates hang out for most of 2023 and probably early 2024. So, yeah, I want to go into this. Okay. So I kind of jumped ahead on this. We talked about the Fed's dual mandate. And again, I think that's as financial advisors, we do feel that, that having a dual mandate is helpful in guiding the economy, because it forces the Fed to look at, value creation and what people are paying, and also labor markets when it looks at the health of the economy. And again, short term, though, the Fed has to make some decisions to deal with inflation because inflation's gone up so much. So you're seeing on the left-hand side, the graph here, that job openings are starting to drop. You've heard about, and it's kind of interesting because normally when labor starts to get impacted, you tend to look at the lower paying jobs and the blue collar market. We haven't seen that has changed much. In fact, you drive around Northeastern Ohio, you still see job openings for those type of positions. Where you're seeing it impacted is in the white collar markets, and you've probably seen much more in the news with the tech companies laying off, quite a few people, from Amazon to Twitter. A lot of the what they call the FANG stocks are laying off people. So you're seeing it more on the white collar side than you are the blue collar. But regardless, you're starting to see that the openings are starting to decrease. And then the next one is on the payroll side. The way that the economy is adding jobs is at a slower pace. So I think the Fed is seeing a softening. They're not looking to have 10% unemployment. So let's just get that clear. But they're willing to see unemployment go up a little bit if it helps pull down inflation. And I think that's what they're trying to do right now, is the relationship between the labor market and where inflation is the disparity is too great. So they have to sacrifice something to get that to work. And one of the ways you do that is if you soften the labor market and you drive down consumer confidence, there's less people willing to spend money. And if there's less people willing to spend money, inflation naturally should start to rein in itself. And the last slide talks about leaving wage.
I'm sorry.
It's all right. Leaving wage growth robust as unemployment stays low. But you're starting to see at the tail end of these graphs, they're starting to flatten or drop. And I think that, again, what's important is the Federal Reserve isn't looking to create high unemployment. They're just trying to soften it enough where that the demand and how people feel about spending their money is going to be curtailed. And again, it's like walking a tightrope. And unfortunately, the challenge is it's not instantaneous. It's not like you walk into a bedroom, you turn on a light switch, and the problem adjusts itself right away. It takes time for any of these actions that the Fed does to work its way out of the system. It takes 3 to 6 months to see the effect of interest rate increases or the impact on the labor market. So a lot of things you're hearing and seeing today, you're going to start to see and feel much more in the first quarter of 2023. So with that, I'm going to transition to Cynthia on the recession piece.
So actually, Frank, I'm going to talk about and share with everyone here. Obviously, one thing it's been concerning investors and the markets is that if an aggressive Fed will put U.S. economy into a recession. So to answer the question, I would like to show you a recession risk dashboard showing on the screen here. So as you can see, the dashboard is comprised of 12 different economic indicators to assess the risk of recession in 3 major areas of the economy: consumer strength, business activities, and also financial market condition. And you can see the green arrow is expansion, yellow dots is caution, and red is recession. So if I may draw your attention to the last row of the table, and you can see the overall signal change from green in June to yellow in July, and then red in August to October. And in October, you can see there were only 2 green indicators which are jobless claims and the truck shipments. And the two signals that turns weaker from September to October were job sentiment moving from green to yellow, and the yield curve from yellow to red. So on the yield curve side, U.S. government 3-month rate rose above the yield on the 10-year bond in mid-October. And this so-called yield curve inversion indicator has the best track record in forecasting recession across a range of economic variables, and also has successfully called all recession in recent decades since 1960s without any false alarm. So in conclusion, we do believe that the odds of recession are materially higher today than they were since we spoke with you last time in June. So that a US recession is coming probably in the next 6 to 12 months. But that being said, we also believe that if a recession comes next year, it may not be as bad as many might expect for a number of reasons, which we can see on the slide here. The first is important is the financial health of US companies is still strong. As you can see in the first chart on the left, the blue line shows the net leverage of US companies. So it refers to a net debt as a proportion of a company profits measured by EBITDA, so earnings before interest, taxes, depreciation, and amortization. And this is an important gauge of a company's financial health. So you can see, follow the blue line, it shows corporate leverage is very low at about less than 4%, compared to pre-pandemic year at almost 5%. And also, I think it's important to notice that we are here looking at the US high yield net leverage, meaning we're looking at the lowest credit rating segment of the US company. So even with that segment, their financial health is still quite strong. And if you look at second reason we feel like, the recession, if it's coming, may be shallow, it's also, Frank has alluded to, is the low unemployment rate, looking at the chart to the right. The unemployment rate is near the multi-decade lows, and also strong job markets, and the steadily increased wage growth, we believe will continue to support the consumer-based economy. And lastly, in the middle chart, you can see the US consumer still in strong financial shape. Following the yellow solid line in the middle chart, you can see US household saving increased from 10 trillion at the end of 2019 to more than 15 trillion most recently. And the total savings are at the highest level since the last 2 decades, and are about the long-term trend. And in addition, you can see from the purple line, the household debt services as a percentage of household disposable income is less than 10%, which is the lowest since year 2000, and also is the lowest since 1980s, but we did not show the longest time frame here. So really, most of the dry powders we see on the excess savings are in the hands of the top income households. In fact, as of mid-2022, household wealth had increased by nearly 25 trillion since 2019. So even accounting for the large equity price decline in the first half of this year, the top income group were able to travel, spend again, and their excess savings are likely to contribute to a higher level of spending and be able to support the economy. So in conclusion, we feel why the recession might be a shallow one, because low corporate and consumer leverage, excess savings among high income households, as well as the strong labor market that support our view. And we believe that it will be a mild recession next year, but not a full-blown and deep economic downturn. The last thing to share with you about recession, if we can look at the next slide. So this is the key for everybody to take away is recession have been relatively small blips in the economic history. And as you can see in the chart, the purplish area are the negative economic impact from the previous few recessions since 1950s. And the negative GDP impact is averaging about 2.5%. Compared to the blue areas, which are the expansions, the GDP impacts averaging about 25%. And the more important message from this chart is that over the last 70 years, the US has been in an official recession less than 15% of the time. And on average, recession lasts about 10 months versus expansion lasts about 7 times longer. And similarly, bear markets have also been relatively short-lived compared to bull markets. So on average, bear markets last for 13 months versus bull markets last for 67 months. And this one we are in right now, it has been almost 11 months. So I hope you take this as a positive news that we may be getting close to see the end of the tunnel. And then really lastly is to share with you that recessions and markets don't typically hit the bottom at the same time. And then in fact, markets tend to bottom out at least 6 months ahead of the end of the recession. So we do feel like no one knows when this decline will end, but we are confident it will end. And that's why we encourage all of our clients not to get caught up in the pessimism and really position for the longer term. In the next section, we would like to share with you is a few principles that are key to successful long-term investing. And we would like to share that with you. First of all, no one has the crystal ball, but we do know that market returns are more predictable over time. The next chart we are showing you here is the historical return by holding period for stocks that in green, bonds in blue, and the 50-50 portfolio. So 50% bond, 50% equity in the gray bar. And this is over different time horizon. The bars show you the highest and the lowest return you could have gotten during each of the time period, 1 year, 5 year, 10 year, and 20-year rolling periods. So for example, if you hold a stock for 1 year only, the range of the investment outcome could vary from negative 39% to a positive 47%. However, if you hold the stocks for 10 years, you will have positive returns almost most of the time. So the longer you look, the markets are more predictable. And the key message to share with you here is really to have an appropriate time horizon for your investments. We heard some clients are concerned that they do not have another 10 years to wait. In that case, we do encourage you to work with your individual advisor to carve out your 12 to 18 months living need in cash, discuss your withdrawal plan, and make any necessary portfolio adjustment accordingly. But you still need a portion of your portfolio really focus on long-term and generating growth for you, because longevity may become a surprise to you. So have a plan and focus on the long-term instead of a short-term volatility is our suggestion and recommendation. Really, the second key message from this chart is also to show you the benefit of investing in a diversified portfolio. As you can see in the gray bars, which is a 50-50 portfolio in all time periods. The range of return you can see in a 50-50 portfolio, it's much narrower than all in stocks or in bonds. So a diversified portfolio does help reduce your portfolio risk. And at PFS, we constantly seek ways to enhance the diversification of your portfolio so you can feel less bumpy than others in a volatile market. And lastly, we would like to share with you is that really focus on the long term and stick with your investment strategy. You should be able to earn the expected long-term return based on your risk tolerance if you stick with your strategy and stay with the long-term view. For example, if you invest in a balanced strategy, you could expect an annualized 6 to 6.5% of return in the next 10 to 15 years. Most people investing on their own don't return as high because they try to very hard to time the market and shifting the entire portfolio into cash when market pullback. And this strategy could backfire because it's hard to find the right time to get back, and the opportunity may have missed. And the second slide we would like to share with you is really remember that markets usually end the year higher. Maybe not this year, but usually 75% of the time, it will end higher. The chart here showing you the worst intra-year stock market declines in red dots, as well as the market return for the full year in the gray bars since the 1980s. So taking year 2020 as an example, you can see market drop at one point, which is about mid-February, 34%. But they ended up the year with the 16% of return. So I hope this chart make it clear that the market correction happens often, but the market is capable of recovering from the intra-year drops and finishing the year positive territory 75% of the time. And I hope this encourages you to stay the course when market get choppy. And really, remember, volatility could be uncomfortable, but it's normal. It's just part of the investing. And treat the volatility as your friend. Take advantage of the downturn to buy the stocks at a cheaper price if you have extra cash. And make sure a portion of your portfolio has a periodic purchase system set up. We call dollar cost averaging. For example, if you are still putting money in your 401k, you are putting money in every paycheck. So even if you are retired, if you have extra cash, you can do something similar too. And this will help you smooth out the portfolio volatilities. So overall, we believe decline really create opportunities for investors who remain calm and stay in the long-term view. And lastly, we would like you to look at this chart. And the next slide, please. Yeah. So this is taking you back from a historic perspective. And you can see how resilient market has been. Looking at the most recent Ukraine invasion to Ukraine, and to the 2020 COVID, and back to the 2008 financial crisis, 9/11 attack, and the recession in 2001. And you can go all the way back. Some of you may still have vivid memory during these times of market turmoil that caused by those geopolitical and financial events. You may feel that the sky was falling when you lived in the moment. However, over time and in time, the financial markets have demonstrated a remarkable ability to anticipate a better tomorrow, even when today's news feel bad. So no one can predict the future, and no two market declines are the same, but we have been here before. And we do know that every bear market has eventually ended, and even during decades of conflicts and uncertainty, the market have generally produced longer growth. Mm-hmm. So overall, we would like to share with you a few more positive trends and tailwinds that we have observed with you. And Cynthia.
Thanks, Amy. Yeah, I have to admit that this year we have gone through a lot. There's Ukraine war, there's those aggressive Fed rate hikes, and we are going through the midterm election. lot of uncertainty in the market and a lot of volatility. It feels very unpleasant and it's exhausting. We feel the same way. But there are some positive trends and tailwind that we would like to share with you, and hopefully that gonna help ease some of those concerns. So first of all, the midterm election is finally over. Normally, when we are in the midterm election, because of the uncertainty, it caused much more volatility into the market, and this year we feel it the same way. But when we look at the 12 months after the midterm election, since 1950, we have not had any negative years. For the past 70 years, every single 12 months period of time following the midterm election, we have positive returns from as low as 1.1% return to 33.2% return. The average return following the midterm election is 15.1%. And this year, the midterm election has produced the mixed government, which normally is considered a much more supportive to the stock market, as when there are two parties in the government, there's balance and check, and it helps to reduce the policy uncertainties. So we do feel that some of the tailwinds to the market in the next 12 months. The other indicator we're looking at, Frank kind of mentioned a little bit about the consumer confidence index. And as this chart shows, this is looking at the past 50 years of data. Just like the business cycles, the market cycles, there are ups and downs, peaks and bottoms. The consumer confidence index also follow a cycle. There are times consumer feels really good about the market and they want to put the money in, and there are times consumer feels very concerned and not really sure what they need to do to protect their investment, their portfolio. During the last 50 years, we look at the chart, we have 8 cycles, which means we have 8 peaks and 8 bottoms. For the 12 months that following the peaks, the average return of the S&P 500 is 4.1%. And the 12 months investment returns following the bottoms is 24.9%, which is really telling us again, the market is resilient. Whenever now everyone is concerned, and that's really the Warren Buffett keeps saying that, you know, when everyone's greedy, being fearful, when everyone is fearful, being greedy. So if we were at the year end of 2021, when client had cash at the time, we were more cautious at the time because we knew that we have 2 really good positive years. So what's gonna be next? Be a little bit more cautious at the time to really pay us back and give us really reward at the time. And now, fast forward to today, the market has been dropped 18%, depends on which index you're looking at. S&P down about 18%, NASDAQ is down close to 30%. So what is going to happen next? In the next 6 to 12 months, we do feel like the market, if we haven't reached the bottom, yes, we are close to it. The next 12 months, we will be expecting and confident to see that there is probably going to be a strong market rebound. So with those tailwind and the positive in the market, what does that really mean to your portfolio? In general, we are more confident in overweighting the domestic equities. As Amy pointed out, most of the US companies have strong, healthy balance sheets. And we are still quality focused, given in the short term, the Fed hasn't really done its job yet. There is still some uncertainty about if the inflation gonna keep drop to a rate that Fed feel that they have conquered that. They have conquered the inflation and will pivot. And we will continue to looking for options to help better diversify your portfolio. One of the, when we look at this year's strategy, your equities, your bond are being more volatile. It's really the alternative investment sleeve that we added to your portfolio has been adding tremendous value to help hold the floor, adding more different source of return yield to your portfolio. Most of those alternative strategy we added to your portfolio either having positive returns or have a very slight little negative returns, like less than 1%. When you compare to the S&P 500 and even the bond allocation, it is 2-digit outperformance in the alternative sleeve. So in really this slide is showing that why we want to be a little bit more overweight into the US market, besides what Amy has pointed out. Really most of the profitable companies are reside in US. As the chart shows, we have 67% of US companies are profitable, with less than 40% in the rest of the world. So overall, we are still confident that the US company can provide us the most returns in the 12 months period of time. And also this year, the strong US dollar also helped the domestic market to outperform the internationals, which the next chart really shows in the long run. When you look at the correlation between the currency and the stock market, you see a perfect correlation that when there is strong dollars, it usually leads to a strong domestic market performance. And when the US dollar starts to weaken, that's where you see the international stocks outperform. So there are still some uncertainty about when Fed gonna start to pivot, but next year when we see Fed start to pivot, that's when it might be a good timing for us to consider switch the allocation a little bit, adding a little bit more to the international stocks. Because valuation wise, international stocks has been very attractive, but right now we just don't feel the time is ready yet. And lastly, bond. Bond has been, depends on what type of bond you're looking at. This year, the bond market has been hammered so hard that it feels like we have been double blading in both the stock market and the bond market. Right now, the bond market yield are much more attractive comparing to the beginning of the year. When you look at this chart, the purple are really the 10-year average yield of those various bond market, and the blue are really where we are. So it's kind of across the board, US, emerging market, international, high quantity bond, high yield bond. Doesn't really matter which one we're looking at, the current bond market are providing a much more attractive yield comparing to the beginning of the year. So what does that really mean? Going forward, the bond market will, again, acting much more like a risk absorber to your portfolio. This year, it doesn't feel that way because the aggressive rate hikes can't hurt your bond allocation. But going forward, with even the high quantity yield are providing 4 or 5% yield, that is give us a really good buffer to your portfolio. So overall, we feel like in the active market, we remain focused on the US, given the US market have the best profitability and the balances are much stronger and healthy. And in the bond market, again, looking forward the next 12 months, the bond will act more like a risk absorber. It's going to help to stabilize your balanced portfolio much better than what we have experienced this year. So what really is the key takeaway for the discussion here? Overall, the inflation, we started to see that the inflation peak is especially on the supply chain end. The shelter inflation, it usually lags a little bit, so it might take us another 3 to 6 months to see that reflecting the data for Fed to really consider to pivot. A possible recession, it might be on the horizon now. However, given all the discussion that we have about how strong the U.S. household with the amount of savings they have, the strong employment market, and the strong U.S. company balance sheets, we do feel like it's going to be shallow if it happens. The market overall has been very resilient. 75% of the time, we do see that the market provides really good returns. So sticking to your long-term strategy is the key for achieving your financial goals. Looking at the next 12 months, we now see that the midterm election is over, and we are close to still around the bottom of the consumer confidence index. Both are telling us historically the following 12 months, we can potentially looking for a strong market rebound, a strong market rally. And lastly, U.S. equities remain very attractive, and there are going to be much more resilience in the fixed income market. So overall, we feel like a balanced strategy, a more diversified strategy, going to help us to weather through a recession if it ever happens. So this concludes our presentation, and I will hand it over to Amy for any questions we have.
Thank you, Cynthia. So now we're going to open up for questions and answer session. I believe you could put in your questions in the Q&A session. I wonder if one of the, and we will just take a few minutes.
I don't see any questions yet.
No, okay. If not, I think you also can send your question to pfs@planfinancial.com, and Michelle can forward to the panelist. And then so we can answer question here for you, as we really would like to make this more interactive and kind of address your concerns if possible.
Yeah, I mean, the only thing I would like to add is what really kind of made this unique is we all, when we started in COVID in March of 2020 in the United States, everyone was impacted to different degrees, but COVID definitely had created mental strain for everybody to different, really did. So I call it, I think we termed it last time, the COVID hangover. So while during this time, our balance sheets, especially our investment accounts look good going into November, December of 2021, I think mentally we weren't on the same page as our finances. We were all kind of tired of COVID. It's impacted our way we live, the choices we had to make, all these things, right? We don't have to go and relive it. But what happened was normal. What we saw happen in 2022, while the pullback was a little more severe than we expected, it was normal. What made it, I think, harder is it felt longer. Because of what we went through in COVID, it's not like we were just skipping along having really, fancy good time during 2020 and 2021. It was tough. And then we start the year and all of a sudden, all these things that were part of solving and dealing with COVID, which was, dumping the 2.8 trillion into the economy. That really came to roost, along with the supply chain inflation, all came to roost in 2022. And it's always easy to be a Monday morning quarterback. If we could have gone back and changed things, the one thing that could have changed and made things a little easier is the Fed starting their increases sooner at a slower rate and slower increases, and it would have been accepted better into the marketplace. The Fed waited a little too long, and then when inflation really started to peak, it got really aggressive and it forced all these changes. So nonetheless, we have to live with it. And as Amy and Cynthia pointed out, there are opportunities during these times, and we do see the light at the end of the tunnel, being a true light at the end of the tunnel, not an oncoming train, as people like to joke. So I think we're coming out of this, and it'll be interesting to see when we get our earnings reports how companies are managing expenses, because it's going to be really the profit margin, and our profit margins coming in better than expected is going to be something that will create an uptick. But to kind of put it in perspective, we get it. No one likes to give value back. I know a lot of people say, well, I lost money. It's like, well, wait, is it value or principle that you're giving back? And if you look at the Dow Jones, right before COVID, Dow Jones was about 29,000. Today, we're floating between 33.5 and 34,000. At the peak, at the end of 2021, we were close to 36,000. So when you actually look at the drop we took in 2020, when we were at about 29,000, that was the peak. And then we had COVID hit and we dropped to 18,000. That was a bigger fall statistically than we are experiencing now. But the only difference is it happened in a 3 months time frame and we got back to normal. Now we're talking 12 months and we're getting closer to that all-time high. But keep in mind, doesn't mean when we hit an all-time high that point in time is a fair valuation of the market. Just like when the market's at the bottom, it doesn't mean that's a fair valuation for the market. So I think everyone got enamored with 36,000, and that's really what my portfolio should be worth. And it's like, well, wait a minute, should it really be worth that? Was it overinflated because of the Fed putting money into the marketplace and kind of throwing gasoline on a fire and really picking up the economy that way? So these are all things that kind of influence the value. So I just want people to kind of put things in context that right now we're sitting in a pretty good position given all we've gone through over the last 11 months. And we're not far off, the Dow Jones high. And I think, December is going to be an interesting month. Will Santa Claus give the markets a gift where, people right now spending looks pretty robust. Right now. So will that all pick up the market, and will we see in January a little market lift? So, as everything is pointed out, most people are investing long. You need to weather, these drops, because they do happen every 7-10 years, these big drops. And it is pretty normal in a given year, even in a solid year, to have a 10% pullback. We just kind of doubled down this year, given everything that was going on. But we do feel we're heading in the right direction. A lot of the worst is behind us. And I think people should feel confident going into 2023, despite the fact that there's recession talk and it might be a light recession, that we're going to be in a better position 2023 than we were in 2022. Oh, we have a question here.
Yeah.
Do you feel companies increase or decrease their dividends in 2023? So Cynthia or Amy, you want to take that one?
So client or participants are asking if we feel company will increase or decrease the dividends in 2023. I think a quick answer, it will be industry or company driven. It's really hard to draw a general conclusion. That's first response I have. And secondly, I personally feel because financing rate for the company are going to go up, that might affect a little bit on their actual money to increase the dividend. So that in general sense, that might be impacted. My third response to this question is, really curious about why this question is being asked. Is that because you are trying to use the dividend to provide for your income? And I'm just curious. And so in a way, I think dividend investing or equity with dividends growth is an important part of our portfolio, but again, we need to be more diversified and not focus on one area of strategy. I don't know, Cynthia, have anything to add?
Well, yeah, to Amy's point, really, when we look at our strategy, we are more total return focused. The dividend is an important part of the return, but that is only a component of the total return. So when we construct the portfolio, we want to make sure that the total return get to the point that it's going to help you to achieve your long-term financial goals, whether it's coming from dividend income or it's coming from the capital appreciation. Now, if looking for 2023, if the market going to have the rebound as is indicated, but after the midterm election following the consumer confidence bottom, so it might come more from the capital appreciation than coming from the dividend.
So yeah, really encourage everyone. If you have any question, we maybe take one or two more.
Yeah, don't be bashful. You got two very smart ladies on the screen here, so I want to take advantage of them.
Plus one investing veteran here.
Doesn't look like we have any more questions.
Okay, there's no. Okay.
All right. Well, if anyone has any questions in the middle of the afternoon, or you wake up in a cold sweat and you say, I forgot to ask this, just shoot us an email. You can shoot it to our general email for clients that obviously have my email, Cynthia's or Amy's email. You can ask any one of us, and we'll get a response back to you. But most importantly, we want to wish you and your families a very safe and healthy holiday. And celebrating the holiday traditions that your families like to do. And please let us know if you have any questions, and look forward to a much better 2023. Okay. Thank you.
Thank you. Happy holidays, everybody.
Happy holiday. Take care.
Bye-bye.